Hello and welcome to IBTimes TV. I'm Leanna Brinder, Deputy Business Editor for the International Business Times. Joining me now is Selwyn Blair-Ford. He's the Head of Global Regulatory Policy at Wolters Kluwer. Hi.
Hello.
Well, thanks for joining us on this sunny day. Well, one of the things that may be darkening the industry, I suppose, or is a bit murky, is the raft of regulatory changes that are coming into the force across UK, Europe, US. What ones would you pick up on that are causing the biggest concerns in the industry?
I mean, that's a difficult question, mainly because of the volume of changes we've got. Clearly, what's on everybody's mind is Basel III and Dodd-Frank, and then there's all the other regulatory changes that spin off of that, such as liquidity, CRD4 in Europe, and you've also got other regulatory concerns like things like Solvency II for insurance, all of them playing a big role in the way that firms have to behave going forward.
Well, since the onset of the credit crisis, naturally regulators have tried to make the industry more safer by putting these new regulations in place.
Yeah.
However, there's now, it seems, a complex network going on in terms of the different changes across different regions. So in terms of something like capital requirements, how is that affecting the industry and how difficult is it for banks to keep capital raising up?
I mean, this is quite an interesting question because the Basel III and the capital requirements have been quite universal. So if you look by jurisdiction, they are impacting all banks, and it should be creating a level playing field. However, you'll find the banks themselves are actually finding it quite difficult to actually make sure they have enough capital and liquidity in some cases. But this again varies by jurisdiction. So typically speaking, we find that in Asia, where they didn't have as bad a financial crisis as they did in the United States or Europe, they actually find reaching the quantitative requirements of capital and liquidity and leverage not as difficult as you find in Europe and in the United States. And you could actually just see that by looking at some of the Basel papers on the progress and implementation, for example, and that really clearly demonstrates it.
Yeah, and I mean, picking up on having capital and I suppose more cash on balance sheets, it also affects companies when it comes to the different regulations in terms of clearing on an exchange, holding a certain amount of collateral. So again, this is more money having to be sitting there as a buffer zone. How is that impacting as well?
So the increases in capital and increases in liquidity and buffers and collateral will result in actually it being more expensive to execute any particular transaction. So you'll find that what we're seeing is that over time the business models so some firms need to be re-examined, and they need to make sure that they're using their capital and liquidity in the most efficient way. It will result in low return on capital, and banking per se, the expectation is actually that banking will be less profitable going forward. Now I know this is considered to be a problem for many banks, and a problem for many people that commentate and look at the financial industry. But if you actually look at the design of the financial regulation, this was what was considered to be a desirable outcome from way back in 2008. So if this is the case, it means that the regulations are working as planned.
Well, naturally, with the changes in capital requirements, liquidity, and then all the other regulatory changes happening, naturally that's going to companies and banks are going to need more infrastructure and, of course, put that in place to keep those, be compliant in the future. How much is that actually going to cost businesses and banks, and where do you think they'll be hit hardest, I suppose?
So the most obvious costs that people look at are usually the ones that come out in the cost-benefit analysis when they actually perform answer the change, and I think that some of those usually focus on cost in terms of number of people, new technologies, etc. However, really for most of these changes, the biggest cost isn't that. The biggest cost is the reduction in the return on investment that you suffer. The biggest cost is the fact that the amount of activities that a financial firm will be able to do will be more constricted by liquidity and capital concerns. One of the real key things to remember is that going forward, what the banking industry will find is that regulatory capital and regulatory liquidity requirements will become more of a confining and restricting feature than economic capital. And so, as a result, looking and making sure you understand the regulations and the impact to your business becomes that much more important today than it was previously.
Absolutely, but from your point of view, do you feel that firms are actually as prepared as they should be?
Now that's really hard to say. My guess is they're not as prepared, and this goes back really to when we looked at the 2008 crisis. When you look at the way the regulations are developed, many people and many in the industries looked at the financial the changes in the financial regulation. And some looked at it as a whole, in a holistic viewpoint, and will change all their processes and started to consider things like liquidity, leverage, and exposure and transparency together. You have others that are really to hit one problem at a time, and what you discover when you do it that way is that you really maintain the same silos and then find later that you have to break them, which in the longer term, even though the approach may appear to be more logical, turned out to be a more expensive way of approaching things. Overall, the industry is prepared. The regulations regarding capital, leverage, liquidity, etc. have been around for a long time. However, what we'll find is that you'll find that many of the processes people have created so carefully to build these probably won't work as well as they think they do once the regulations really go live and are seriously enforced.
Well, that is really interesting. So, I mean, rounding off, what would you say are key milestones or points to watch from the regulatory point of view?
I think immediately, if I was an observer, the things to watch would be the known timeline. So we know that in 2015 the LCR will come in. We have an expectation for Basel III to be finished in 2019. However, with all these measures, one has to remember it normally takes anything between a year and 2 years for the impact of a new regulation to really impact the business and the way people behave. So I would really be looking to see what's being suggested, implemented a year or two after any particular policy change is actually initiated.
Great. Well, thank you very much for your time.
Thank you.
And that was Selwyn Blair-Ford. He's the Head of Global Regulatory Policy at Wolters Kluwer.